thank you everybody for joining us today. I'm Justin, and hosting with me is Adam. We're the founders of Elevated. Elevated is an operating system for decentralized finance. Currently, the DeFi system is too complex for mass adoption. That's why we are aggregating DeFi into an easy-to-use interface. And from now on, we will be doing regular events like this one. This is a call with Christian Kamir and on the mass adoption of DeFi. Christian Kamir is managing partner at Sustany Capital, a thesis-driven venture capital firm investing in decentralized finance, money, and legal technologies. Chris has been a tech entrepreneur since the internet dial-up days and led the merger of the earliest internet service providers in Europe. In 2000, he moved to California to start a technology venture fund. Chris has studied classical literature, is certified in neuro-linguistic programming, and a graduate of the Münster School of Law. He's a board member at Open Travel, co-chair of the Banking and Financial Services Interest Group at the Decentralized Identity Foundation, and lectures on Fintech at Harvard, the Frankfurt School of Finance, and the Nova School of Law. Chris has been speaking and writing on topics ranging from high-tech investing to decentralized finance, identity, and blockchain since 2008. His current book project, working title, Streaming Money, will be published in the second quarter of 2022. Christian, thank you for coming to speak with us today. We've prepared some questions, and I understand you've prepared some slides to answer them.
Yeah, this will keep me on track, I hope.
So we've given you a brief introduction. Please, could you provide a background on you and your firm, Sustany Capital?
Yeah, first the obvious, the funny accent originated in Germany, albeit I was an exchange student in Coventry in the 80s. In the 80s also I got into programming, mostly self-taught, also did an internship at Siemens Nixdorf where I found out that I'm probably not the best programmer in the world, so decided to go to law school. After law school, joined one of the first internet service providers, and as you pointed out, we were very lucky to sell that company to what's now the largest ISP in Europe, Tiscali, at the height of the .com, retired from the law that day after being a lawyer for only a couple of years, and moved to Southern California to set up our first venture fund, which at the time was focused on voice over IP solution, multi-massive online player games, shares a lot in common with what we focus on today, which most people call the blockchain space. We call it something else, doesn't matter. Intermittently, I ran a little startup that was Yelp before Yelp. We sold that in 2008, and I came to the realization that we never ended up doing what we set up to do, which is build the World Wide Web. So I started to discuss this ironically on Facebook. So we had a discussion group on the decentralization of the web on Facebook in 2008. And more importantly, we started to look for technologies that would lend themselves to build the internet for the world for the first time. So that's how we came across Bitcoin and then Ethereum. With Ethereum, I met my now partner here at Sustany, who created the Ethereum meetups in Orange County. We were one of the first allocators to that ICO. And we started to look for investments in the space. We share very much the same philosophy and outlook on technology and investing, which in our case means we're applying the scientific method as much as possible to the topic. So we write our own research papers, we share those for peer review. We look at every startup as an experiment on these ideas. And so after doing this for quite some time, we looked at more than 1,000 projects and tested out our thesis with our first fund, which we ran as a family office. So that worked out really well. So we're raising our second fund at the moment for the first time, allowing outside money. We do our own skunkworks development. So we build DeFi Solutions through a different entity. We run a hedge fund team where we build our own technologies as well. But I spent most of my time talking to startups, talking to the actual players in the space, building open source technologies. And that's why I hold these different board positions. I do a lot more than those. These are just kind of the official ones.
Okay. So Christian, you've been investing in technology for more than 20 years. As a technology investor, how do you think about finance?
Yeah, maybe just the the quick disclaimer, and maybe I'm just gonna start sharing my screen here. Oh, you need to allow me to share my screen again, so people don't have to.
I am making you host.
Okay. All right. So first, I have to do the obvious disclaimer here. Whatever I'm presenting here is obviously not legal or financial advice or any kind of advice. It's just my personal opinion and thesis. My hope in life is to make better mistakes tomorrow, and so what I'm sharing is basically for peer review. And so my objective is not to indoctrinate, but to educate. And so when we first set up to do this here, and let me remove myself from the screen. So when we first started discussing what we wanted to do in the space, I have a big whiteboard here to the left of me. We started to aggregate all the big numbers of how money is being formed, how it's being moved, and so forth, and started putting labels on that. And you see some of those here. If you pay close attention, you probably notice that I left out derivatives, which make combined actually 20% more than the entire area that you see here. So more than stocks, bonds, CDs, and so forth combined. And so we have a pretty simple model when we look at those. So as an investor, there's two kind of paradigms that you follow. Investment is about timing. And in the case of technology investing, which we are technology investors, it's timing the development of technology, how the stack is being built. We have the saying, being too early is the same as being wrong. And so I was wrong a lot in my past adventures. We were trying to build a unified messaging system on the AOL backbone. I think it was around 1994. It was ahead of its time in 1994. Today is still ahead of its time. But then in our narrow focus on financial technologies, we look at this across very simple stages, across the stages of what we call creation, so the formation of money, if you will, of value, storing and of value, moving it, and how you govern it. And so within those, what we're trying to do is we're trying to identify frictions, and then essentially, and this is covered by this top here, essentially then trying to figure out what is the total addressable market within the classification that you saw earlier, and then across the stages of creation, storing, moving, and I'll explain this later in greater detail. And from here, we can see if that was concise or if that provoked any questions.
So if anyone wants to, from the audience wants to ask any questions, please feel free to use the chat. So
I'm trying to figure out if we can hide this top panel here. This should actually disappear, right? Usually. All right, if not, we'll keep going. I see some chat question here.
So, Christian, developers all around the world are untangling the centralization of the internet.
Yep.
This trend is widespread, and it is clear that decentralization is one of the most important, if not the most important, aspects of any proposed solution in this space. Why is decentralization so important? And what do you think it looks like developing?
Okay, so yeah, the way I came to this topic is what we discussed earlier before we started this call, as me coming to the realization that we never developed the World Wide Web. What developed is we are developing or developed thus far is the commercial web. So whenever you go online, you're mainly actually interacting with just one entity, i.e. you Google something, right? So what does that mean? Well, you are now a non-player character in a game called Google. You're not on the World Wide Web, right? So you're running a query against a database that's being maintained by one particular entity, one for-profit company that has certain objectives. And the main objective of every company, obviously, to increase shareholder value. So we have to see how they're implementing this and whether or not you're the user and you're the product. And we can talk about that more. But so right now, the way this is expressed, so you're the individual. You might have many accounts. So you might have an account that several banks, you might have an account at some trading organization, and you might have accounts at social media sites and so forth. So they're all what we call account-based systems. So an externality of account-based systems is that you only control your persona, i.e. in the data that you have control over, and then you have a lot of other data that you don't control, that other entities of these account-based systems control, and that's usually called a profile, i.e. I profile you, and that can take on the form of you having being assigned a FICO score, a credit score by a credit rating agency that then your account is being attached to, and this is how the interest rate that you might be paying is being generated. But it's not something that you can directly influence. It's not something that you control. The data is sitting in some data silos that you oftentimes don't even know exist. So there's thousands of these profiles and tens of thousands of these data sources. So for you personally, your personal identifiable data is probably in about 5,000 different databases with as many records, and in some cases 20,000 records for profiles. So what's my point here? So the point is that basic network technology from a high level essentially looks at every human being in the same way it would look at an IoT device. Let's call it a weather station, for example. So it will observe your behavior, it will collect the data that you're creating, and then commit this to some data silo. Then we'll refactor it as a profile for the utility of that particular portal and or platform that you're engaging with. And so that is a pretty important paradigm to understand this. To then quote unquote decentralize that, we have to reverse the topology. And so if you look at the new evolving layer, I'm simplifying it here massively, obviously it's way more complex, but then you have the underlying protocols, so what people call Web 1.0. I don't really call it Web 1.0. We never really got to Web 1.0, Web 2.0, and Meta and everything else. Those are just marketing labels. They have nothing to do with the actual state of the technology itself. But so you have underlying technologies, actual protocols like TCP/IP, HTTP, and then obviously blockchain-based solutions make use of that. That's why I actually don't think of blockchains as being protocols. Oftentimes you hear people say they're protocols, but they're not protocols in the network sense. They're protocols in the sense of financial engineering, in the sense of you having some form of business logic that actually makes use of these underlying real protocols in the network system. Then we need to develop a lot of other technologies that are right now centralized. So right now we're using centralized naming conventions, DNS servers that are being run by commercial entities, and all of those lead to the fact that you don't control any data or most of the data that you're creating when you actually should. You should have property rights to all the data that you're creating as far as I'm concerned. But in order to untangle this, we need to replace all these siloed functions into decentralized systems. So we need to have decentralized bandwidth, decentralized addressing, decentralized compute, which is something that Ethereum originally obviously wanted to do. And then you can ultimately engage with these solutions using what we call right now wallets. But from a technical perspective, wallets are very much browsers. They let you browse a blockchain and then manipulate those entries for which you hold the private keys. And then on top of that, you have decentralized applications. And as you guys know right now, it's pretty complex, and that's the main reason why we're talking to engage with these decentralized software solutions, which is my term for blockchains, and there's other decentralized software solutions. And you have to, in many cases, first buy digitally native assets to engage with those. You have to install these runners, or what people call wallets, in order to engage with those. But ultimately, that's what we need to get to, because to simplify this massively, and then I'll show you another high-level slide. So in a way, you can look at this from the perspective, everything that's digitally native, I can exchange and govern with digitally native tools, i.e., very simple example, if I want to buy a CryptoKitty from you and I'll send you some Bitcoin for it, then I can do everything using a smart contract system. However, if and when and where I want to buy a real world item, a real cat from you, I'll send you a Bitcoin and my real world cat doesn't arrive, I need the evidence rule for the nation state to enforce the mechanisms that return this Bitcoin to me and or get you to fulfill your original promise of delivering me a cat. So the point here being is ultimately all the value, as it usually does, is being aggregated to the application layers that fulfill these functions, because ultimately finance doesn't exist in a vacuum. It exists to facilitate real-world economic activity and is largely a subset of the law, which is still mostly misunderstood because the space at the current state is largely driven by engineers, which is a good and a bad thing. And if I look at this from a very high-level perspective, so if you're just looking at commercial activity, so how we usually treated finance, let me blend out myself so you can actually see everything and make myself invisible here. So if you look at this from a very high level, so before the invention of digital technologies, before the early 1960s when we developed COBOL, the first database solution, we facilitated commercial activity using paper-based solutions. So you had file folders and cabinets and written contracts and papers that you would exchange and so forth. And so once we created databases in the 60s, we started to more and more do these recordings in, I didn't actually switch this, and do more of these recordings in databases. And then we sort of made a mistake attaching these databases to network technologies. And in a way, you can think about this from the perspective of databases were never intended to be connected to networks when they're being developed, and the externalities from doing this are horrendous. Last year, the cost of cybercrime exceeded $6 trillion, as one example. That's larger than the GDP of Great Britain, is larger than the GDP of Germany, it's larger than the GDP of all but 2 nations in the world. So ultimately, from a high-level perspective, what decentralized software solution, including blockchains, address is that particular problem, that you cannot protect bytes that are stored in a database, whatever these bytes express. Could be a person identifiable data, could be value entries, and obviously the bytes don't care what they're actually expressing. So from a very high level perspective, you can look at this from pre-digital era to Web 1.0 and 2.0. Again, these are just marketing terms, to now decentralized software solutions. So I'm gonna take a breather here and make sure that this was semi-coherent.
The quick question: what was the size of the crime externalities that you listed?
Yeah, so it's estimated, I give a separate talk on cybercrime, but it's estimated last year it exceeded somewhere in the neighborhood of $6 trillion. So in the United States, there's a data breach approximately every hour, and this is public data, because companies that experience these data breaches actually need to report this.
Anyone has any questions, please write in chat. My other question, you say that currently currently the space is being driven by engineers. You said that's not a bad thing, but it's not necessarily the optimal thing. Who should be driving the space?
Well, it should be a collaboration. So we created these artificial disciplines of legal and engineering and so forth. That's not how colleges actually set out. It was more like a discussion forum. So the point there being is, by and large, what these solutions are, they're legal technologies. So we really need a discipline that's legal engineering. But what happens right now is, so you got an engineer who has a particular idea of how legal concepts work that he never validated, and or if and when and where they invited legal professionals, what we see on a daily basis, they will explain the letter of the law to engineers. And what happens invariably, they don't understand the objective of the law. So very simple example. So the regulation of KYC, know your customer, and to prevent anti-money laundering is implemented in a way that's attached to legacy technology. So the fact that the fact that we have account-based systems. So you open up an account and they want to know everything about you. They want to have a government-issued credential, and if you're in the United States, they will ask you for a social security number and so forth. And so every time you're using your checking account that has been treated in this particular way, the bank will attach all your PII, all your personal identifiable data, and share it with on average 4 to 5 entities in the process, even though you could have done this particular transaction using cash and in person. It was just more convenient to draw from your demand deposit account, what people call your checking account. So the externality that you're sharing this PII and then incurring these externalities of being part of some form of cyber exposure, cyber crime, is by and large an externality of these legacy technologies. And we attached laws and regulation to the legacy technology because the middleman has custody over this particular information and his technology is limited. So point here being, where we have decentralized software solution that attach PII only to a transaction, if there's a court order, then doing the opposite is simply unlawful, is illegal search and seizure and invasion of your privacy, quite obviously. So that's an important thing to actually explain to engineers that engage with legal professions. Those legal professionals should explain the objective of the law. The objective of the law is not obviously to spread your personal identifiable data across a number of different data silos. The objective of the law was to prevent money laundering. And decentralized software solutions can do that and can do this much better than engaging some intermediary and enforcing them to basically spy on a personal transaction.
Okay, thank you. Justin, do you have any questions? I'm going to move on to the next question.
I think we can move on.
Okay. So decentralized money truly began with Bitcoin in the wake of the 2008 Great Recession. As cryptocurrency and digital assets have evolved, the role of this revolutionary innovation has shifted. What are your thoughts on Bitcoin and where do you view its utility?
Yeah, so the most, to me, important thing that the Bitcoin white paper introduced was the concept of a new form of capital formation. So if you look at capital formation today, the standard way is that of a corporation, right? So the first corporation was created actually by your country in 1600, the East India Corporation. And the problem with corporation is you have a lot of different entities that are involved with those. So you've got operators, you've got employees, you got clients, you got suppliers, you got shareholders, and then you also got governments that in some shape or form might be actually engaging with those. So the point here being is all these entities have different objectives, right? So as an operator, I'll try to create the most profit. As an employee, I want to earn the best income I can probably achieve. At a client, I want to buy the cheapest and best product. As a supplier, I want to increase my own profit margin. As a shareholder, I want to see the value of my shares increased and so forth. So the point here being, they don't necessarily work in sync, right? So they don't have the same objective. They don't necessarily pull in the same direction. So what Bitcoin introduced, which I think is the most important primitive to understand, is that of a decentralized autonomous organization, to where the owners, the investors, and the users and employees and so forth all have the same objective of increasing the network and the value of the network utility. So if you look at then examples across the current space of capital formation, you can look at companies like JP Morgan Chase, and so they have 250,000 employees and created transaction volumes of 2.3 trillion. I'm not going to read all of these values to you, but the point there being is within a decentralized software solution, like a Bitcoin DAO, you only got a few employees, you got a lot of volunteers, but you got a lot more transaction volume, as you can see, and you're creating revenues for everybody that voluntarily participates in that system. So there's no Bitcoin corporation that extracts value. There's no Bitcoin corporation whose primary objective, primary algorithm is to increase shareholder value. And so it incentivizes the alignment of interest within the system, because obviously no one is forced to use Bitcoin or any other network. You're participating by either buying the Bitcoin mining reward, so lowercase b Bitcoin, and or you start running a node or a combination of the two, or you use the network for other purposes, but your interests are generally aligned. There's not necessarily a purely extractive element in there. So, questions at this point?
Specifically, you say that the value of Bitcoin is the new capital model it's introduced, that it was the first successfully implemented peer-to-peer decentralized currency. In terms of the active network growth and utility of Bitcoin, do you have an opinion on the utility of the Bitcoin network today or in the future?
Yes, 100%. And I think it's actually much simpler than most people think. If you just read the abstract even of the Bitcoin white paper, it should be fairly obvious, right? So Bitcoin started with the idea to build a peer-to-peer electronic cash system, right? So that was its original objective. And I think a lot of people would benefit from just breaking this down and understanding this better. So if you just think about cash, so cash is one form of money, and it's a good form of money in the sense of, if I have it and I give it to you, I don't have it anymore, and it settles the transaction with finality. So it's a bearer instrument, albeit this is not quite correct with banknotes in the strictly technical legal sense, because you don't actually own this particular instrument that you're looking at. You actually get limited usage rights to that at any given point in time. It's actually owned by its issuer. So it's an IOU that you can only use in a particular way, i.e. you can't deface it, or you can't write on this. This is actually a crime if you do that. So that's something maybe to remember, which is different from other purely bearer instruments. So, but unfortunately, what happened is a lot of people have been indoctrinated in a definition of money that sounds something like that. So money is being explained in business school as a medium of exchange, a unit of account, and a store of value. Well, this is a definition that was created by William Stanley Jones in 1875 in a little pamphlet called Money and the Mechanisms of Exchange. And money didn't look the same way back then as it looks today, and obviously communication doesn't look the same way as it looked then. This is I don't even know if you recognize this. This is a telephone which Alexander Graham Bell filed a patent for the year after Jevons wrote his definition. By the way, just as a side note, Graham Bell did not invent the telephone. There was a Italian engineer by the name Antonio Meucci some 27 years earlier. So this is one of the common other myths. But then it's important to understand that money is really something very simple. Money is simply an agreement between two or more people. Currencies are something different. Currencies are systems of money that standardize the agreement over money. So then it's usually employed to solve what we call the coincidence of ones, or sometimes double coincidence of ones problem, or what people call the barter problem. And then the use cases, so the function clearly is simply that of language of value. So first, when you agree on something, you agree what's our language of value. If you're in the United States, you might simply default to the US dollar. If you in Great Britain, you might default to the British pound sterling, but that's just your default. If someone decides within any given country that we want to do business in another fiat currency or business in Pokemons, then at that point in time, this is money in our context. Or if you find yourself incarcerated, you all of a sudden find out that what you thought was currency is actually contraband, and that all of a sudden your currency are cigarette butts, right? And so the larger point there being is you need to differentiate between the functions of money, which is simply that of language of value, or you could call it a pricing function, and the use cases. And so the use cases, the primary use case of fiat money is that of lending. It's usually created by the way of lending. And then the secondary use case is that of spending. And then the last use case, and that's where fiat money is really terrible, is as a store of value, because there will never be less of fiat money, as we know from history. So then one important thing to realize is the medium of exchange has defaulted to bytes, right? By and large, your transaction occur by moving the control over bytes from A to B. And so no one can probably read what's on the screen here, but as a frame of reference, the left box shows you 94,643 Bitcoins, or about $3.7 billion. Whereas I said right, it's actually left. And the right box shows you $3.70 worth of US dollar. So the default medium of exchange has been bytes for decades. So the difference is that the legacy system relies on database solutions that don't actually give you control over your own bytes, whereas the new system actually lets you control bytes. But then again, bytes don't care what you call them. You can call them US dollars, you can call these bytes BTCs, you can call these bytes Pokemons, you can call these bytes whatever you want. It's just a coincidence that we call certain bytes lowercase b Bitcoin as in the mining reward for Bitcoin. It's important, by the way, to always distinguish this. A lot of confusion is simply being created by conflating the two, by conflating the network with the mining reward, because the unit of account, by and large, for Bitcoin is not Bitcoin. It's the US dollar, right? So if I'm in the United States, and for you it might be British pound sterling, if you open up your digital wallet, you probably see the value of your Bitcoin in British pound sterling, I would assume, which tells you that the unit of account is something else. And the lowercase b Bitcoin is simply the incentive mechanism of that particular public network. I'm going to pause here and make sure that everybody is following.
Very interesting. Since the inception of Bitcoin, there have been more than 13,000 new tokens released to the market. What do you think about cryptocurrencies as a whole and how they fit together to form the decentralized financial system?
Yeah, so as I was saying in our pre-roll, so it's important to understand that any token is nothing more but a standardized smart contract. That is all it is, right? And so that's why to try to classify those is somewhat problematic from a multitude of different reasons. So I'll put a couple of the most common classification on here. So we talk about commodity tokens, we talk about network tokens, we talk about stable coins, we talk about governance tokens, and so forth. So by and large, that has some utility, but from a narrow sense, every token is its own contract. It's its own standardized smart contract. That is all it is. By the way, and most people don't know that there's a difference between coins and tokens. So coins are the native reward mechanism of a public blockchain, and tokens are basically an API function, like the typical token would be an ERC20 API function that interfaces with the public Ethereum mainnet as a standardization function. But a better way to think about this is in terms of what Nick Szabo coined a digital vending machine. So in the case of a vending machine, you might have some goods or services that are being stored in this instrument, and then you approach it with your coin or token, and you can engage with this digital vending machine to obtain something else. Obviously, Bitcoin is a very difficult to program smart contract system. It's a very simple system that is mainly good for one purpose, which is to move BTC or move the control over bytes from A to B. But then because of those limitations, we created other more complex systems, i.e. the Ethereum smart contract platform. So you got more complex digital vending machines. And so the way this expresses itself then, if you compare Ethereum with the legacy things that we called Fintech, by the way, and in my mind, Fintech is one of those other marketing advertising terms that's very unfortunate, because in my mind, technology's purpose is to be deflationary. And if you look at things like PayPal's and other window dressing solutions to the legacy financial systems, they are extra extractive. So they actually don't have a deflationary element to them. They're actually causing more fees, not less fees. They're just more convenient to use. That's why I think of DeFi, decentralized finance, really as the first fintech solution. So if you read my last Forbes article from December, I'll explain it in more detail. But then when you compare this, and by the way, obviously all of these comparisons that we're going to make are somewhat apples to oranges. They don't map to each other really well. These are just for storytelling purposes. But you have entities like PayPal's with tens of thousands of employees. You got a network like Ethereum that only has like less than 100 core developers that are actually being paid. Obviously, you have a large army of open source developers that exceeds 200,000 people on the Ethereum mainnet right now. But you can see already that the Ethereum network has way more transaction volume, is much less extractive, even though people obviously complain about gas fees. That's its own topic. But then is really growing in value compared to the legacy systems. Again, that's because it is way more comprehensive in the types of problems it can solve. And so that's why, by and large, and then we open up for questions again, by and large, I think of decentralized finance solutions really as the first fintech solutions, to where we can remove the middleman, and they are first and foremost, so that's a very important thing to understand, the things that we used to call fintech solutions. That's why I tell prospective LPs always look at your current portfolio, because if you have bought something that was sold to you on this under this marketing term fintech, this is one of the first things that actual fintech solution, what we call decentralized finance solution, will wipe away first before they go to traditional finance. Questions? If not, we can move right on.
So Christian, what are your thoughts on the decentralized financial ecosystem as it exists today? Currently, there are around 100 million people using DeFi. And what do you think about the state of DeFi adoption?
Right. So we'll get to adoption later, and then I will break that down more. But first, like, here's in very rough terms how I think about the space. You saw commercial activity at scale earlier, like how we think about that. So we'll break this down somewhat similar. Let me turn off my camera here so you can see all of this. So these are the large buckets that we can observe right now. That you see that symbol up there. This is DeFi Llama, which aggregates a good amount of this data. You're probably familiar with it. And so you'll see that the bulk of the activity is in the decentralized exchange space at the moment, and then the next thing is lending solutions. But also, if you notice, these values right now are counted in billions. If you remember from my earlier slides, all of those values were trillions, not billions, right? And so it's very, very tiny compared to real world economic activity right now. The main reason for that, I kind of touched on that earlier, is because it's largely disconnected from real world economic activity. It's basically, you could call it a multi-massive online player game. It's self-contained because you're dealing by and large with digitally native assets. In the lending space, it's usually either over collateralized, or it's a new type of CDP form, but by and large it doesn't affect real world economic activity at the moment. So that's why the most important thing here is to realize we need to create these on and off ramps. And in a way, what we have done is we created this intermediate stages, and when you compare those, you can look at a company that is basically not part of the blockchain ecosystem, but is adjacent to that, like a centralized exchange like Coinbase, and you see the same dynamics, right? So they have already more than 1,000 employees. By the way, they were the first company to file a public S1 without actually identifying a physical headquarter, which is sort of interesting. That's very novel. But if you compare then with a DEX, with a decentralized exchange, you can see that the decentralized exchange has a fraction of the number of employees while having pretty much the same trading volume already, but being way less extractive, as you can see by the revenue numbers, and right now has a smaller market cap, but it only has been around for 3 years. So you can make a lot of these comparisons in that space that kind of demonstrate this. Again, word of caution, this is all somewhat apples and oranges, right? So you need to always take this with a grain or shovel of salt. But another application here would be, if you look at the centralized lending space, if you're looking at something like Lending Club, same thing here, right? So you got 1,000 employees at Lending Club, whereas Aave has less than 100 employees, and Aave already creates more loans than Lending Club, right? And Lending Club has been losing money, whereas Aave is actually making money, and Aave already exceeds the market cap of Lending Club in a fraction of the time that it took Lending Club to get to that particular volume. And so if you compare these different solutions, we looked at the big buckets earlier, you will find these dynamics over and over again. It just hasn't spread yet to the general public, and I think we're going to talk about that at some later slides here. Questions here?
Talk about on and off ramps in order to increase real world adoption and usage of cryptocurrencies. Could you talk a little bit about how you foresee those solutions being proposed?
Yeah, so right now we have a problem that we touched on a little bit earlier, as in by and large the topology is not understood. The fact that we are using client-server architecture hasn't been understood. There's this entire focus on standardized smart contracts, or what people keep calling tokens or coins, whereas the main focus should actually be on the client software. So by and large, people don't adopt technology, they adopt solutions, they don't adopt protocols, right? So your mom didn't adopt voice over IP, she adopted Skype or WhatsApp or whatever. So so at the current state, all those solutions basically are addressing the problems that engineers have, not the general public. So your mom might never find the need to buy anything else but Bitcoin, and maybe she doesn't buy any Bitcoin either, but probably doesn't see a need to buy Graph tokens or Dogecoins or any of the other, like you mentioned, whatever 30,000 tokens and coins we have right now. So the point here being is, in order to actually get to adoption, what we need to simply do, not simply, it's hard, it's to abstract these technologies, these plumbings away from the user, so that people don't have to adopt voice over IP, but they can adopt Skype. So that would be in your client technology, i.e. what people keep calling wallets right now. And again, wallets are really more akin to browsers, because if you think about it, so the default medium of exchange for all these things is simply bytes. Bytes in principle can move at the speed of light, and however you want to visualize your bytes is basically a user interface function, right? So if you want to see the value of your Bitcoin in US dollars, then you toggle to the US dollar. If you want to see it in British pound sterling, you toggle to British pound sterling. And if you want to store value, well, you probably don't want to store all your value in Bitcoin. At least I wouldn't recommend it. I would recommend that you definitely have some of your store of value in BTC specifically, but that's its primary use case. Larger point here being, though, is we need to realize that we need to work hard on these on and off ramps and extract these particular units of accounts away, because we don't need more units of accounts, we need fewer units of accounts. So if you're looking at your earlier example, if you have like a robo-advisor function, does the public really care what type of portfolio they're holding, or are they caring about the yield that it's making? Or do they really care if the bytes while they're being moved are being called USD, USDC, USDF or something else? They don't, right? So they just want to make a payment, and they don't want to pay a fee for that payment. And specifically, if you're the recipient, if you're the merchant, then you don't want to have to tag on 2-3% for the privilege of moving the control over bytes. So larger point that being is, by and large, the evolution to actual application levels that doesn't require the user to learn a new language, the language of Ether or the language of Dogecoin or the language of another unit of account, is the crux here, right? And then also, and that's more a regulatory point here, since legacy service providers in the space are tightly regulated, regulators, and we'll talk about this probably later a little bit more, but regulators have been addressing this particular space, that whenever you become the middleman, whenever you become the custodian, you're exposed to these type of regulations, right? So that's why my general statement has always been, if and when and where you have exposure to regulation, you probably didn't implement the technology as intended, because regulation mostly addresses the behavior of middlemen, the problem that you introduce when someone else has custody over your assets, over your funds, where you create the principal agent problem. And yes, we want those entities to be regulated, we want those tightly to be watched, but if you're actually using digital bearer instrument, that friction goes away, right? Because there is no middleman involved that introduces those frictions. But the incentive mechanism here, unfortunately, for the past decade has been to invent your own unit of account when this is actually not needed. So that's why when you see examples like El Salvador, they are mostly using the Bitcoin Lightning Network as intended, as in it's a network function, but the unit of account that they're using on top of that is the US dollar, right? Because people by and large obviously don't want to spend Bitcoin, right? And you shouldn't spend Bitcoin. It's the old adage that people call Gresham's law, that bad money will drive good money out of circulation, which actually dates back to Aristotle much earlier. But the point there being is always the same. You need to present the user of a technology where he or she doesn't have to learn a new language as a starting point. That's the largest friction you could ever introduce. Like that's a pitch I get on a daily basis. You only have to buy some Ether and then you can do X. Well, that's a lot of friction, right?
Yes, fundamentally, this is the problem that our solution Elevated is solving. So by just supplying the system through which to engage, the operating system, you're enabling mass adoption. You're pioneering the engagement by as you said, putting the plumbing in the behind the walls and just interfacing that market activity. Enables or it empowers individual users to use the advancements of digital economy and all the advancement of digital economy and all the various use cases developed without having to learn all the technical expertise, all the macroeconomic understanding, all the microeconomics, all the technical complexity. All that's needed is for the engagement of the vending machine, say, or the operational engagement to be presented intuitively so that users can capture the benefits without learning all the complex, technical, chaotic backend.
Yeah, and maybe one thing, so we think about this in both top-down and bottom-up development. So what I mean by that, so the Top-down developments would be something like Figure, which is an application on top of Provenance, which is one of our portfolio companies. So they facilitate loan origination, started with HELOC, moving down the value chain and introducing a stablecoin and so forth. So the point there being is, so they didn't start by building cryptographic primitives. So they just tackle one particular problem that they can optimize, which is the problem of loan origination and the fees attached to that by aggregating top-down value on that part. So in a narrow sense, they are at this particular stage more like a DLT, like a distributed ledger technology, but they're already using an underlying blockchain called Provenance to then ultimately decentralize more and more function and eliminate more and more middlemen. And obviously you can do this bottom up as well. So you can just introduce a digital bearer instrument and then start lending there. But the problem, again, is always the same. If you want to facilitate real world economic activity and you need to integrate with legacy accounting system, well, they don't speak Bitcoin, they don't speak USDC, so they speak in fiat, and they have certain regulations and restrictions attached to that, right? So that's why you have to look at this from the perspective, where will you find adoption first, right? We're going to talk about that some more. And so the way we think about this, if you don't have infrastructure, right? So where there is no, let's call it technology debt, where you have a country maybe in sub-Saharan Africa that never had a land registry and or has a land registry that's still entirely paper-based, which exists today, then they can leapfrog the database stage. They can jump right away into a blockchain-based solutions and make all of their records NFTs that then can be from the starting point digitally native. Albeit, if you have a land registry that's database driven, well, now you got potentially hundreds of incumbents who simply make a living for maintaining this particular data silo. And so that's a lot of additional friction on top of that, because they are legacy players. And another point that we see on a daily basis is there are existing data exchange standards for all these institutions, for all these commercial activity that exist, that by and large are being ignored by developers in this space, i.e., if you don't know that there's certain metadata being exchanged between financial institutions, between telecommunication service providers, between travel organizations and so forth, then if you're building an application that addresses this particular sector, then these particular participants in that ecosystem are unable to adopt your new technology because you don't understand how data transfer works in that space. A very simple example that I usually make in my talks about that, let's say you want to provide a better travel experience and you start selling tickets as NFTs that then maybe even have secondary markets, right? That would be great. If I have a airline ticket and I can immediately put it on a secondary market without paying for a name change and so forth, I can create more efficient markets and immediately transfer the rights to those, and I can build these locally and so forth. But the point here is that currently the way this system works is there's 3 data silos in the background that maintain these systems that come with certain metadata that's catering to legacy technologies, i.e. something like Edifact, like a telex. As an externality though, if your application doesn't know about this, doesn't cater to that, and your name doesn't show up on a telex on some godforsaken airport somewhere in a certain way as a real world consequence, you will be sent right back home, right? So all of a sudden you find it in a situation where commercial activity was actually not able to be facilitated because you didn't understand how the legacy systems work. So that's something we see consistently, right?
Yeah, and it's one of those problems, especially when it comes to on and off ramping transactions. There's so much personal identifiable information and metadata for any digital transaction in the legacy system that just doesn't need to exist and doesn't exist in the new financial system. I'm aware there's several solutions that exist that are trying to solve this. For example, Alliance Block, but I haven't actually seen it. effectively implemented?
Yeah, so the bottleneck here is, and that's a whole a separate talk really, is what we call identity right now. So the way that you quote unquote identify yourself is by providing a government issued credential usually, right? And so by and large, these exist in paper form right now, or like plastic cards, right? Which is kind of funny that we still have those, right? They were good instruments at some point in time. So what I mean by that, and that's a metaphor I think is useful to embrace, and actually the more important primitive, think about like a government issued credential before the introduction of digital solution, before the introduction of databases. So you would have something like a passport, and it was in physical form. You would have it in your drawer. And if you wanted to use it for something, let's say enter an airport or something to that extent, you would take it out of that drawer, put it in your pocket, go to the airport, you show it to the individual who needed to see it, like a gate agent. He would inspect it and then verify that you're not on a paper no-fly list, and then hand it back to you. So point there being is, what we need to realize is we need to create these particular, in this particular case it's a credential, in purely native digital form. And those efforts are underway worldwide. So there are several states right now in the United States that create digital driver's licenses. So these are the more important primitives, because value only exists in the context of the individual, of the rights owner, right? It doesn't exist in a vacuum. It's only value as far as you having it, you're controlling it, you're having the rights to it. And in order for you to be able to, for the time being at least, get the enforcement mechanisms of the nation state, you have to use this government issued credential, and that just doesn't exist in digitally native form. However, since we are seeing those come alive, if and when and where they do, these are going to be the most important primitives to engage with, because at that point in time, the name of your coin or token is basically irrelevant. The only thing that matters is what's the ultimate utility it provides to you, right? Because now, in order for you to attach something to that government credential, you can just simply hand over what I call a green check mark. Because typically the bank, for example, doesn't do KYC because they want to really know you. They want to know that your first name is Adam, your last name is Maxwell, and you're living at this address and you were born on this particular date. What they only really want to know is that they are able to service you, that you have this green check mark. So once we have these solutions, we need to make absolutely sure that is actually the only thing that we are passing on, this green check mark. And we're only passing on this green check mark on a transaction by transaction basis, and not indiscriminately for every transaction because it's convenient or desirable for the recipient. And honestly, the recipient usually shouldn't actually want to have that, because it creates a new risk. Now you have custody risk, and custody risk is not limited, as I mentioned earlier, to assets. It's also very much attached to the fact that these entities have custody over your personal identifiable data that people can and will abuse. And that's happening on a daily basis. So that's very important to understand from the actual design perspective, how decentralized software solution and specifically decentralized finance solutions need to be created in order to be able to engage with real world economic activity. Again, comes down to discussing different new units of accounts and so forth is pretty much as relevant as discussing the colors of bytes.
So the original topic of this conversation was about the DeFi ecosystem and the state of adoption. And we mentioned that for people to adopt DeFi and cryptocurrency digital assets, rather than get them to adopt each individual token, smart contract, and protocol, we want them to adopt the client software. The experience that's a wallet user interface that is the interface of additional abstraction. So that's encoded on top of that foundational experience. but that they just want the strategically advantageous solutions. I would like to hear your thoughts. That I think that the foundational point of adoption, what universally people want, what our mothers will want, and why they would adopt this technology, comes back to inflation, comes back to bytes. People want to generate bytes. People want to generate digital assets, and through technology, we can enable this via computation. So the crux of Elevated is you have a data-centric financial infrastructure, generate traffic over that, and compute that against the well-validated statistical algorithm of some unit of account, whether that's Bitcoin, whether that's USD, whether that's anything up to the user, and then digitally transform the interface, the user experience, through the captured, harvested, and analyzed data in order to influence directly the unique evolution of the digital transformation in a strategically advantageous operating system. In this manner, all individuals, regardless of their technical expertise, will be able to successfully engage decentralized economic systems intuitively, just through application, generating bytes and exploiting or taking advantage of those underlying innovations.
Yeah, so by and large, if you look at the space, most of the spaces right now is still comprised of the value of Bitcoin. 40% of the entire market cap of blockchain-based solutions is still anchored in Bitcoin, with another, I think, 20 or so percent anchored in Ethereum's network and expressed as Ether. And then you have another, I think, last number I saw, an aggregate of 10% was attributed to what we keep calling stable coins, yet another really terrible term. But you got all these what we call adoption signals, right? And by and large, I mentioned Bitcoin. MicroStrategy doesn't really use blockchain-based solutions, right? So MicroStrategy will just buy Bitcoin and put this into their treasury. Same with Tesla. Square is building some blockchain-based solutions, but a lot of the other entities just look at the store of value function of BTC particularly and start using that for its purpose. And then you got a lot of adoption signals from all the usual suspects that claim that they're going to build on blockchain-based solutions. If you look behind the curtains, as usually DLTs, usually distributed ledger technologies, which are in many ways the opposite of decentralized. They're in many ways the opposite of blockchains. They're more like shared databases. That's at least how I think about this. So when you ask about DeFi adoption, so the questions become actually more complex, because DeFi adoption, you should always ask, like, adoption by who, adoption why, for what, and then how do you adopt it. So if you measure that, and that's pretty easy to do, then all you need to do is look at the current holders, by and large, of wallets. And this is the current number of wallets. So less than or about 5% of global internet users have wallets right now. A lot of those, as I mentioned earlier, essentially just bought some Bitcoin or maybe some Ether on a centralized exchange and do some self-custody in some limited shape or form. But by and large, they're not actually engaging with the decentralized finance space. So this is really, really tiny right now. But once you break down the actual use cases, that's what you should be doing. Then you look at individual use cases. The typical example would be Tether. And that's why again, it does make very little sense to put labels on like a stable coin. So we call Tether stable coin, and within that context, it has right now still kind of the largest market cap. So the market cap is somewhere around 80 billion. Why does that matter? Well, it only matters in the context of what is the volume, what's the turnover of Tether. Well, in the last 24 hours, although this is a couple of days old, so this is not from yesterday, it's from last week, I believe. So in any given day, the entire market cap of Tether will turn over once, and in some days it will turn over 4 or 5 times. And that's a term that in the traditional finance space we call the velocity. So if you then compare this with traditional legacy finance and you compare this to the US dollar, this is the US dollar's velocity by quarter. So as I mentioned earlier, the velocity of Tether in a given day is about a 1. So the velocity of the US dollar in a given quarter is maybe 1. So within that context, but again, going back to the further slide, what you see here, these are the use cases of Tether. So the use case of Tether is to stay on this centralized exchange and exchange Tether against BTC, exchange Tether against ETH. So why is that the use case? Well, because if I move into fiat, I incur fiat fee, I incur friction, I incur maybe KYC, I incur any type of friction that the legacy fiat system introduces that I can avoid. But that's the single use case, right? The singular use case is to stay on a centralized exchange and avoid the penalty of going into fiat. And so point here being is, whenever you look at any of those blockchain-based solutions and or i.e. tokens and coins, you want to very narrowly actually examine its particular use case and what it does and how it grows, if it grows within that particular use case. So simply saying crypto adoption, cryptocurrency adoption, blockchain adoption is utterly meaningless, right? There's no such thing. That is like saying voice over IP adoption. You're not telling me anything, right? So first voice over IP adoption was largely when it became a viable protocol, moving from H323 to SIP, was by and large done actually by telecommunication companies for their backbones. It wasn't done by the public at large. That came later, when we had free software clients like Skype and so forth. Then the general public got engaged. And that eventually led to the fact that people stopped paying by the minute. And so the larger point here being then is, in a way, the way look at this space is very similar to the move from, and Roger Ver originally created that term money over IP. It's very similar to that, moving from voice over IP based solutions on from landlines to where, when we still were limited to the national telecom and their landlines, they metered us by the minute. I remember when I first moved to the United States, calling back to Europe was like $1.15 per minute. So the first thing that I did, because I have some limited technical knowledge, I set up a dial around service for myself. So I would call my office, I would get a dial tone in Germany and then dial my colleagues in Germany from there. So I only had the local cost. It was a local call for me, but most people couldn't do that, obviously. And that's kind of the state where we are. Most people can set that up to benefit from the actual efficiencies of these quote-unquote protocols. Again, most of these are digital vending machines. They are not protocols. That they live on top of protocols. But the larger point here is, by and large, I look at this from the perspective of that the legacy incumbents, including the governments that put them into this position where they can create money, so mostly commercial banks, they kind of pretend like we didn't invent money over IP. They pretend like we didn't invent digital bearer instrument, because we are still being metered every time we are moving bytes, if we call those bytes US dollars or British pound sterling or some other fiat unit of account. And right now that makes up about 30% of banking revenue, just moving bytes. Think about that. And I think I took out the slides on CBDCs, and maybe we talk about that. So central banks around the world have been quote unquote researching central bank digital currencies for quite some time now. And two of them eventually came to the conclusion that we came to 4 years ago when we first started looking into these implementation, which meant that, well, Similar how Uber doesn't need any dispatchers, money doesn't need any dispatchers once I have the Uber app for money. And so what that means is that 30% of commercial bank revenue could simply go away overnight right now. But we're keeping them artificially alive by simply ignoring the fact that digital bearer instrument exists. They cannot be uninvented, but right now they are not being made available to your mom. And ironically, those two discussion groups are research groups on CBDCs across the world that recognize that simply stopped researching and kind of waited for that to play out. And that's what we kind of see here. And earlier I mentioned to you, we're formulating a response right now to the discussion paper around the Federal Reserve's here in the United States discussion paper on central bank digital currencies. And if you read that, which I encourage everybody to do because it's kind of significant, like very emblematic to all the central bank discussions, so it's worth reading, and probably has the most important effect on global finance ultimately. But it simply avoids bringing up that topic. It avoids speaking about the fact that digital bearer instruments exist, that they can readily be deployed, and that your mom and you and everybody else doesn't have to be metered for moving the control over bytes. I'm going to end my rant here and make sure that we answer every question that came up. There's a lot more where this came from, obviously.
So you mentioned that the term crypto adoption is meaningless.
Yes.
And I agree. It's a general term. It's more marketing than anything. But I think, okay, well, how about we define it then? I would say that most people exist today outside the game. They've heard of crypto probably by this point, hopefully, but they haven't engaged with it. They don't use it. They don't own any. They consciously have yet to adopt the new macroeconomic paradigm that we definitively exist within, have done so arguably since the advent of Bitcoin. This has massively accelerated as a direct result of the coronavirus pandemic. And with the emergence of decentralized finance over the summer of 2020, this is the new macroeconomic paradigm. Most people have yet to understand that, accept that, and therefore adopt the corrective strategies there, which is to leave the funny money behind, not abandon fiat, because fiat's still something we'd be using until it ultimately fails. But fiat money is failing. Most people have yet to accept that. Most people have yet to adopt digital assets as their currencies. So I think that's how we should define it. And then there are different levels to immersion into decentralized finance. So some people, especially the older generation, they may merely adopt the stores of value and asset classes digitally, whereas particularly the younger generation growing up fully immersed, able to code, playing games with NFTs, natively transacting in digital, in crypto, they would be much more fully immersed, much more able to learn all the different functionalities, utilities. Their brains will be plastically molded natively in this ecosystem.
Yeah, I mean, the simplest thing at this point in time to adopt, by the way, fiat is not going away. Yes, fiat system will always fail, but they fail as a reset, because that comes back to what I said earlier. Real-world economic activity is by and large facilitated by nation-state enforcement, so by fiat mechanism, unfortunately. So for the time being, and also as a pricing function, we will still use that. But you should think of this in the same way that you look at any other shitcoin, right? So that comes back to you want to hold on to your stores of values. You want to hold on to your stable coin, and if you just adopt Michael Saylor's strategy, well, you convert as much of your shitcoin into an actual store of value. Specifically, if you can borrow shitcoins for 1%, well, it's inflating away at a rate much, much higher than that. So from that perspective, yes, we have a good use case in terms of BTC as a store of value. As far as exchanging value, you will see this by and large where the local currencies will fail entirely. But here's the thing, and that's coming back to the earlier example of El Salvador. So El Salvador adopted the rails for Bitcoin, and their specific Bitcoin Lightning for the transfer of value, but adopted the unit of account of the US dollar. And so here's important to realize, there's very few people today that use it as a form of payment, because the primary function, again, the function is different from a use case. The primary function of money is that of pricing. So do you expect to see a price of 0.000012 BTC on your banana? I assume not, right? So a Bitcoin doesn't have a minting function if you want to really use these metaphors from our space and claim that we have Bitcoin mining, right? Again, there's a lot of unhelpful metaphors in our space that people adopted, like coins and tokens and so forth, that we could have simply avoided. Obviously, there are no coins, there are no tokens, right? These are all just standardized smart contracts. These are all just software. So you need to implement it in a way that facilitates a current utility. And that's why often a fallacy that we see is that developers are trying to solve for a problem, obviously, but then they identify the wrong problem, i.e. they identify the commercial bank as a problem. Well, it sort of is, but simply the mere fact that this bank has clients will tell you that the bank is solving for a problem for these clients. So you simply need to solve the problem that the bank solves better. So right now we have this utterly absurd scenario here in the United States where there's more quote-unquote money, US dollars, right? More fiat currency collected in CDs, in certificate of deposits and money market accounts more than ever due to money printing, and where it earns you a yield of, if you're lucky, 2%. And by any charitable measures, this is way below inflation, that particular return, right? So you're losing money on a day-to-day basis, basically, right? So, and as you know from the decentralized space, there are quote-unquote stable coins that will earn you a yield of 19%.
Sometimes even 70%.
Or more, right? So there is, right now, though, there's a lot of counterparty risk. Most of that is technology risk, and it's the fact that there's not a whole lot of decentralization, and specifically there's not a whole lot of decentralization of these elements that I showed you guys earlier, to where we're still relying on centralized interfaces that then again might rely on centralized storage, or it's an application that's running in your browser, which is operated by a centralized entity, and you're using a centralized ISP and so forth. So there's all these attack vectors that you're creating with open source software solution, if and when and where you still got intermediaries that you as the users aren't aware of. So coming back to the most simple example, in the case if I actually have cash, physical cash, I control it, I have possession, I can hand it to you, I don't have it anymore. We never actually got to the stage of peer-to-peer cash right now, and really it's not really the best metaphor, even though I keep calling these things digital bearer instruments, because technically what happens is that you're depositing something into this digital vending machine for either a moment or maybe a longer period of time, using whatever prerequisite is needed. Simplest primitive is cash, right? So simplest primitive is simply, I want to quote unquote pay you. So, but even then I have to commit it to a certain smart contract. I need to hand over control over bytes from A to B. Well, by and large, you're not just exchanging money for money. You're exchanging money for some other value. And again, if this other value is not digitally native, if it's not a CryptoPunk, if it's not a CryptoKitty, if it's not some NFT that is just a digital collectible, but it represents a right that you must enforce in meat space, well, then you also need to be able to do a number of different legal concepts in that smart contract system, in this digital vending machine, i.e., and that comes back to there's a lot of language missing for developers. You need to do some authentication, verification, identification, authentication, and so forth in order for you to be able to deposit this right or asset. By and large, we're talking about rights at this digital vending machine, and then your counterparty needs to do the same to pick it up there. So simple example and typical example that people make in our space would be the transfer of a house. Every day I hear metaphors like we tokenize real estate. That is a very unhelpful metaphor, and it sounds to me very akin to a child taking a picture of a house with their smartphone saying, Mommy, this house is now digital. Obviously, the house is not digital, right? So you just took a picture of that house. So you cannot tokenize anything that's not digitally native. That's very important to realize. So since you cannot tokenize it, you have to ask yourself, okay, what does the nation state require in order to facilitate real world economic activity and get you this particular title? Well, first, the title has to be digital native, right? So if that doesn't exist, it's impossible. You're limited to just providing a platform. And that's why a lot of these things that we are seeing right now where people claim to use blockchain-based solutions, they create new types of data silos. And whenever you hear the term platform, that's what it is. It's a data silo of sorts, right? Because it facilitates all the mechanisms that don't exist yet, where we don't have digital barrier instrument that you could actually transfer quote unquote peer-to-peer. That's what the platform does in this particular case. It will do the authentication, verification, then store your personal credentials on that platform so that if you need the enforcement mechanism of the nation state, you can go back to this platform and the platform furnishes those, let's call it evidence for that particular purpose. Right, so that's an important architectural design to realize that by and large is being ignored. So that's why by and large the space is basically a multi-massive online player game. And I don't mean this disparaging. I think this is a good thing. We should obviously test these systems ad nauseum before we facilitate real-world economic activity with them. But the best way to do so is with open source software solutions, because they exist out there in the wilderness. That's why you probably have heard this expression, Bitcoin is a sewer rat, right? So it's very resilient. It will bite its way through. It's very hard to kill. It will survive an atomic attack, and Bitcoin will work regardless if the internet still exists, right? So we need to just get to the stage with other decentralized software solutions, including decentralized finance solution, before we can get to that particular stage. And again, it's important to understand that if you're adopting a similar model like the legacy intermediaries, well, then you are the new problem, right? So that's why originally, to make one particular example that should be really obvious, we looked at hundreds of payment solutions, and they still appear here on my desk and in my inbox. And they usually pitch us of being better, faster, cheaper. Well, ask yourself, what should the alpha be in payments? How much extractions should there be for moving the control from over bytes from A to B? Well, my personal answer, by the way, the market, the alpha of payments last year was, I think, 7.3 billion. So what should the actual alpha be? So my answer is pretty close to zero, right? So changing the control over bytes doesn't take much effort, as in it should cost about as much money to move the control over bytes that represent US dollars or Bitcoin or something else for that matter, as it costs to send an email. I don't know how many stamps you put on your emails. I regularly avoid that. I'm going to stop here. We can talk about regulations, CBDCs, NFTs, or many other things that intersect with the topic of decentralized finance.
Just to clarify your last point there, so it should cost basically however much it costs to uphold the network. In the example of XLM, which is better, faster, cheaper,
those are two different topics, right? So because all the value ultimately will accrue to the application. So the application provider will find out how to create the alpha. But if you're just trying to make money from moving control over bytes, you will have a hard time, because there's a saying that we have, your alpha is my opportunity, right? So your friction is my opportunity. And so the cost of moving the control over bytes really should be zero. So you need to actually provide something on top of just being, let's call it, a payment service provider. So provide me with additional utility, because if I do a cash transaction, then I don't pay any fees, right? So the actual end user should not actually incur a fee from handing over control over bytes. So
if you look at XLM, it costs one lumen to transact, and the additional utility that you have is that you own your supply of lumens. There is I don't know the exact token economic modeling design there, but I do know that lumens has gone up generally. Sure. You can lose, but you're getting very, very cheap transactions and underlying asset appreciation.
Sure, but that's, so again, if you're building an application that makes use of this particular network and you incur a transaction fee, then I think it would be rather foolish to pass that on to the end user. You need to actually provide an additional value, and that additional value could manifest itself in a monthly membership fee, and you're also gaining whatever loyalty points maybe, or you're gaining additional analytics, or it also provides you with some robo-advisory or whatever else. So payments, as far as I'm concerned, is a solved problem. It's one of those realities that's simply not evenly distributed yet, right? Because at the end of the day, again, we're talking about the colors of bytes at this particular point in time. So you just pick the bytes that provide the least friction. So if my bytes still provide friction, then I look for the ones that don't have that friction attached to that. Comes back to the early example. I can use a centralized exchange and then incur custody risk and higher fees, or use a decentralized exchange and I do self-custody and then incur more risk on my end, and maybe it's worse to me, right? So maybe that's a fee I'm happy to incur, because I like that someone else is taking on that risk. But maybe I also instead want to use a wallet that just provides me the insurance that even if I self-custody, it will reimburse me if and when and where I lose control over my private keys instead, right? So that seems more likely. So, but that's directionally what we are seeing in the space, quite obviously, right? So we came from these centralized service providers, and that's why you see the multitude of people that engage with the space will engage with these centralized service providers, because they solve for that friction, right? So they solve for the fiat on-ramp. I don't have to start with first figuring out how to get possession of XLM or Ether or something else, right? So that's the function that they fulfill at this particular point in time. But I look at them very much as like internet service providers in the late 90s, right? So in the late 90s, we had to send people around with dial-up modems that they would install into people's computers and configure them to our network. It was hard going, right? It took us, I think, 2 or 3 years to aggregate 350,000 users in this particular way. But obviously now, no one thinks about this anymore. By the way, there's still people on dial-up, but I feel sorry for them, but they still exist. But by and large, people use broadband connections, and they are not getting metered by the minute for the bandwidth that they're using. I assume you pay a fixed amount and you use unlimited bandwidth and maybe even unlimited compute, depending on what type of services you have, right? It's just the current kind of primitive state of the space. But yeah, you're absolutely right. I mean, XMM would probably facilitate the transactions that Visa facilitates on a daily basis. I think we did the math at one point in time. At that point in time, it was for the value of like $25 to $50 of lumens a day, and you could run the Visa network if you wanted to on Stellar.
Right. So it's very easy to transfer the ownership of the private keys on a single network, so on a centralized exchange or on one application, one wallet. But when you're dealing with the DeFi ecosystem as a whole, or the real world economy, Stellar, provides this basis of cheap, fast, better, and it's interoperable and it's near universal. It's not limited to just one or two blockchains. As such, that's utility to use this as a to underlie transaction payments.
Right, but obviously want to abstract this away from your user, right? So your user should never have to own XMM or any other quote-unquote cryptocurrency. As I mentioned earlier,
instead, the application encodes that and applies a digital transformation, whereby instead of you sending, I've spoken to people say, why don't you adopt crypto? They say, I don't want to spend $100 sending Ethereum to someone.
Exactly.
I say, why would you? Like, that's not what it's used for. They don't realize that you should be using these specialist solutions that have a competitive advantage in transacting at low fees.
But this is also just another technical layer, though, right? If you
it's
have
a technical layer,
and again, by and large, people will never experience that and wouldn't want to. Like
they shouldn't have. If people have to learn, these technical complexities, they will never adopt the technology. It has to be encoded into an.
And the worst friction you could introduce to any of your applications if they first have to learn an entirely new language, right? So that's what I see on a daily basis. Like, well, our unit of account is called gobbledygook. Whatever gobbledygook is, right? XML, Ether, it doesn't really matter, right? People, by and large, will stick to the unit of account they have been indoctrinated in, for good or bad, right? But just realize that from their perspective, money is just their language of value. That's all that is. Don't try to indoctrinate them into a new language of value. It's not going to work. Or maybe it's going to work with a very, very tiny subset, kind of like the 150,000 people that ever bothered to learn Esperanto, which was kind of this artificial universal language for the world. And I think less than 200,000 people actually ever bothered to learn it, right? It's the obvious thing that you don't want to do. So that's why you totally want to abstract this away. And they are specific to understand, like people right now, what do they use cryptocurrencies for? Well, by and large, it's for speculation, right? It's like, with the exception of the ones that we think that gonna stick, it's just speculation, right? So it's number go up technology. It's not because anything else.
I'd say without the operating system for the masses, you just to adopt those underlying innovations is just too difficult, arguably impossible when we're talking about mass adoption without the effective operating system.
Yeah, I mean, people adopt solutions that solve a problem, right? And usually the adoption is best done by elevating some form of pain. So people react to two inputs, pain or pleasure, with the more potent one being pain. So, and there the obvious one is, if your currency is being inflated away, and I'm not talking about the US dollar, although obviously that's also being inflated away, but
also emerging FX.
Yeah, but as we know, for other countries is much worse, then you can address this particular problem, but you want to be paying attention to history and how traditionally this problem was solved. And we can just simply observe how it was solved. So over the past 100 years, there were a number of fiat currencies that failed. And more often than not, what happened is that these countries with the failing currencies adopted a new unit of account and that most likely was the US dollar. So now a lot of countries pegged their own currency to the US dollar. So they are thinking in dollar. That's their language of value. And so after their currency failed, what they first did, and in some cases that caused that country to adopt the dollar as the new standard for the language of value within their borders, was they started to import physical cash, Federal Reserve notes. And that's why the majority of Federal Reserve notes that were ever printed and existed actually exist outside of US borders. And so it solves a problem for people in those countries. And so the point here is very obvious. If, when, and where we have a digital dollar that's backed by a federal government, at that point in time, it's basically game over for that local currency that's inflating faster than their own currency. And again, you want to separate the functions. Like network technologies, I think it was Jim Barksdale that made that problem, that statement a long time ago. The internet, by and large, is good for two things: for bundling and unbundling. So you want to unbundle those earlier use cases that we pointed out in this, for this, like Mickey Mouse example. Money is the Mickey Mouse example. It's the simplest smart contract system, right? So you want to unbundle the payment function from the store of value function, from the unit of account function. And it's easy, right? So the medium of exchange defaulted to bytes. You don't have to do anything. Don't invent a new unit of account that you have to explain to your user. And the store of value is always a basket, and your user will decide what the store of value function should be. If you make it very easy for them to dollar cost average into Bitcoin, that's probably a good thing, right? So that is kind of the lowest hanging fruit. Any quote unquote wallet should provide for that function. Any wallet should also provide for the function of just not holding on to shitcoins, including any fiat currency, as long as it takes to move bytes, which is close to the speed of light. So what we call M1 right now, so money in your checking account, in your demand deposit account, doesn't actually have to exist, obviously. From a legal perspective, as a side note, it never existed. So digital money always only exists in a state of lending. The difference is if you give it to the bank gets to lend it. So you basically, money in your checking account is an interest-free loan that you're extending to the bank. There's no reason for that to exist right now. Right? It's the equivalent of a landline. It doesn't have to exist. So money, by and large, what we call money today, doesn't have to exist in the state of debasement because it exists in the state of bytes, which move at the speed of light. So they can always just stay in a state where they actually earn a yield, and you move it only into the state of debasement if someone on the other end is asking for payment. And then it will move in the state of debasement for as long as it takes to move bytes, which, again, the kind of technical physical limitations are close to the speed of light. So it will move from my store of value and yield earning state to your store of value and yield earning state. And at that point in time, the problem that is government issued fiat currency or any fiat currency, it's essentially solved. Like from my perspective, we solved that problem a long time ago. It's just one of those realities we haven't evenly distributed yet. It's our responsibility as technologists and technology investors to point that out and to make it possible, to point out the problem that is government issued fiat and that comes with debasement and other problems, by the way, is solved. We should demand to implement this right now, because the alternative is to act like Mexico did when we invented voice over IP solutions, which, again, they called it, they outlawed voice over IP. Obviously, they didn't outlaw the technology, right? You don't get to outlaw technologies. What they outlawed is the behavior that people under the jurisdiction could exert by engaging with the technology. So they outlawed the engagement with that technology in order for their nationally run telecom to still extract value from running that network. So essentially, by not making digital bearer instrument at scale available to any citizens right now is the same thing, right? But the other part, which is the larger externality, and it kind of extend the realm of our discussion a little bit, but that is actually a much worse externality, is that of surveillance. And so I'm not talking about the fact that you could use quote-unquote cryptocurrencies to circumvent any type of anti-money laundering. I think everybody on the call here knows that this is a totally red herring. By and large, using a cryptocurrency to commit any kind of financial crime is a terrible idea, right? It's very hard to make this undetectable, and it's very relatively easy to de-anonymize participants in the current network, because unfortunately we have invalidated the herd immunity of most chains. I'll explain what I mean by that. But the larger point here is, though, that there's an externality attached to the surveillance mechanism that is legacy financial systems, because most people on this planet live under authoritarian governments. And unfortunately, we're seeing that right now in full force. And so what happens is, if you disagree with that government, it's relatively easy for them to either cut you off and or surveil your personal financial transactions and then react to that if it is in disagreement with the government's opinion. And that could be something simple as the government disagrees with your tweets in some cases, and then disenfranchises you and cuts you off from the financial system, because it has the opportunity to surveil that influence that cut you off from that. So the larger externality of the legacy financial system is exactly that. That is not censorship resistant, it carries surveillance with it and enables authoritarian governments to control their population, including for such crimes as disagreeing with the government's opinion. Right? So that is way more concerning than debasement. Debasement is obviously also concerning, but we can readily get rid of both of those by implementing digital bearer instrument, and by the way, integrating systems that then actually identify real quote-unquote money laundering. Right? Those technologies actually serve to go against money laundering, because it should be the obvious thing should be that if you look at the last 1,000 transactions that you did using your checking account, you probably figure out that you could have done all of these in cash, and it was just more convenient to use it by swiping your debit card or using an app on your phone. But as an externality, there was a wholesale exchange of personal identifiable data that ends up in some databases, and you might not care as much until your quote-unquote identity gets stolen. At that point in time, you care. But again, if you're living on an authoritarian government, it makes it impossible for these individuals to use your application, your new application, if you're still doing that. And so that is, for me, the more important topic to realize, because we advise NGOs that facilitate, non-government organizations that facilitate the transfer of value and information to people that are in these situations, that need to protect themselves from authoritarian government. And our guidelines are basically, if an individuals that being persecuted by their own government, with all the enforcement mechanisms and tools and facilities of the government, cannot use the technology that you're building in decentralized finance or otherwise because of the exposure it's create, then actually no one, not a single person, should be using this application, because you will always endanger someone on the other end, right? Because it doesn't, that comes back to the phrase that I kind of spewed out earlier. By and large, what we did, we invalidated what I call the herd immunity of public blockchains, i.e. The singular use case that should be hopefully clear by now, how you should implement blockchain-based solutions, is to build digital vending machines. You should never, ever record anything. The ledger function, right? So by the way, the Bitcoin whitepaper never mentions a ledger. That's for a reason. But the fact that we record transaction has nothing to do with you being able to look up this transaction later. Think about the headline, right? Think about the headline of the Bitcoin whitepaper: peer-to-peer cash. Do you get a ledger with your cash? Do you get to see where it was yesterday? You don't, right? So it's important to embrace that metaphor and realize, well, if I have peer-to-peer cash, I don't get a ledger, what's the purpose of the ledger? Well, it's in order to sync honest nodes and to enable the state machine. That's what blockchains are. They're state machines, right? So they're not ledgers. They're not DLTs. DLTs are shared databases. So it's the purpose of recording these transactions is to synchronize honest nodes and kick out everybody that's not an honest node. You're no longer part of the network. And again, it's very much on a daily basis that I hear people make this case, well, we're recording XYZ on a blockchain. No. Do not record anything on a blockchain. That's not the point. The singular purpose for a blockchain is to build digital vending machines which hand control over bytes from A to B. If you need a ledger, then that needs to exist somewhere else, right? Because you're invalidating the herd immunity of your blockchain if you commit any type of specifically personally identifiable data to your blockchain or to your dApp, to your application, right? So the obvious thing should be, if I commit PII, personally identifiable data to your dApp, let's say in a European context, all of a sudden you are unable to change this immutable record, presumably. So you're unable to, quote unquote, forget it. So you're unable to comply with GDPR, you're unable to comply with CCPA. Your entire application just became unusable. And that's why I call it you're invalidating the herd immunity of the chain whenever you expose that, whenever you actually save something as an immutable record directly on the chain. That's not the point of a blockchain. That's an entirely red herring, entire fallacy. Blockchains are not databases. Blockchains solve for the problems that are databases.
Thank you. That was very great. I'd like to just bring attention to one point that you made that I think was very, very powerful, which is that loads of existing problems, especially the problem of government-issued fiat and its debasement, is solved. It is our duty to inform the people and get them to adopt this technology.
Yes, 100%. That's why whenever the CBDC discussion comes up, whenever I see a discussion around CBDC or I see a white paper, I always make the point to say, well, you're avoiding the main problem. So the number one problem of government-issued fiat currency is that in digital form is surveillance. And the secondary problem is that of debasement. Neither of those things have to exist, right? There's no law that you should be able to inflate your currency. Actually, there should probably be a law against it, as far as I'm concerned, right? But because as a accounting principle, what is the debasement of a fiat currency that you're obliged to use under legal tender laws for certain things? Well, it's effectively the same as taxing you. And so specifically in a context where another country adopts your particular currency, well, that is what we call taxation without representation at that point in time. So that actually should be unlawful. That should be unconstitutional in the context of the United States. So that's why, to me, any discussion that doesn't first make the point that you can readily solve against debasement, that you can readily solve against surveillance, that you can readily solve against censorship using digital bearer instrument and creating fiat-denominated digital bearer instrument from a central bank, and you're not discussing that, that is simply intellectually dishonest. And it's the exact same thing that countries did throughout history with new technologies, where they just enabled incumbents to still make profits from their technology debt by maintaining data silos. So that is one of the largest hurdles we have to overcome for adoption, right? To get the awareness to citizens out there and to talk to their representatives, to tell them, hey, I don't want to be debased. And by the way, obviously, everybody right now is using bad technology to try to get around the debasement, right? So, i.e., committed to a money market account, committed to a certificate deposit. But these are just bad options, right? Why don't we deliver better options to them and actually introduce competition? There is no law that that says that government have the unalienable right to create more money. That doesn't exist, right? That's just utter nonsense. If you and I decide, by the way, within our context that Pokemon should be money, then Pokemons are money. That's another awareness that people should have. And oftentimes what we actually found, that bankers will spread these fallacies that say, well, under legal tender laws, you have to accept money. No. Legal tender laws are very narrow usually. So they're very narrowly defined that money has to be accepted for certain debts and to pay taxes, fines, and fees. But if you just open up a store and decide, we only accept Bitcoin here, or Ether, or USDC, or USDT, or USDF, or Pokemons for that matter, you are free to do that. So that's the other realization that people need to have. You are free to use anything as money because it's an agreement between two or more people. That's first principles thinking, right?
Would you like to address Adrian's comment, which is, but academia's argument when it comes to inflation is that it is making the pie bigger?
So, I mean, that's a red herring. And overall, I mean, economics is a pseudoscience by and large, right? We need to move it into the realm of engineering. Michael Saylor gives a really great talk about that, if he actually did true financial engineering. So really, you should only create new units of account when you create new values. So in the real world, right? So new house, new value, yeah, that makes sense. Same house, more money makes no sense, yeah, right? So you're first inflating that asset class, and as a second order effect, you're inflating base money supply, right? So and if you artificially, that's the other part to that, if you then centralize the setting of interest rate to a central bank, well, then you negatively influence the lending markets. It's no longer competitive. So the next inflation that we obviously have been seeing is the inflation of stock markets, because it was so easy to borrow money for companies that they borrowed money at sometimes zero interest, which is absurd. Think about this. So you borrow money for zero interest, or more absurd would be negative interest rate. That's absurd under any standard, right? And so no one can tell me that there's any sense to that being a fact, that you should be able to borrow money for zero interest or even for 1%. So the point there being is
a complete perversion of economic incentives.
Of markets, right? So it's a distortion of markets, and this externality in the case of public markets has led to the fact that by and large public companies have been borrowing money for 0 or 1% interest. And what have they been doing with that? They haven't been using it mostly for productive means, which is the only reason actually we should create and borrow money, or borrow and create money in this order. But they have been buying back stocks, competing with other stock buyers, and then driving up the stock prices. So the stock market is inflated by 20 to 30% at least right now. The housing market is inflated by 30%. And these are just simple and obvious externalities from what we call money printing, but it's really an externality of setting arbitrary base interest rates to uncompetitive low rates, right? If that was an actual functional market, that wouldn't happen.
I actually think that what they're doing is somewhat self-sabotage. I think they are actively making the system fail. As we've seen, the greatest wealth transfer in history on crypto, $2 trillion the past year, I think, in crypto games, 1.4 trillion the past year.
Yeah,
is the number there.
Yeah, so that comes back to my first ever point, which is very important to understand. And so if you look at this from global economic perspectives, I think we are attributing somewhere in the neighborhood of 13% to financial services. Think about this for a second. What should be the right number here? I would say the right number that we should assign to financial services in GDP globally should be around 1%. Because, again, financial services don't exist for their own benefit, right? So they should be...
Do you have the existing number?
Do I have the existing number?
Yeah, how much does financial services take up?
I think the last time I checked on it was around 13%. So that you usually, again, it varies widely between the developed nations and the developing nations. But I think on average that might be correct directionally. But the point is simply that we should look at this not as adding to GDP, but subtracting from it, because it's just a function to facilitate real world economic activity. It doesn't exist for its own benefit, right? Unless there's some actual output, some actual utility in the real world. People get to eat, have shelter, get transportation, get to buy goods and services. Well, without all of these utilities, financial services wouldn't exist. It would be a game in and of itself, but it should definitely not be extracting 30% of GDP, because I look at this simply as extracting it. I don't add it to GDP. I think we should just subtract
GDP is a
right?
terrible measure.
Yeah, and specifically,
but it's not so much it's a terrible measure. It's how it's used, and the goal is to drive up GDP. It's like, no, GDP is simply a measurement of gross domestic product.
Right, and also if you look at this in the context of the nation state, and so like fiat currencies in the context of nation states. So if we defer the rights of to governments to create money, well then money is a public good. And so that public good should be provided in the most efficient and just way as possible. That's why we call it a public good, right? It should not be delegated to a few entities that then get the right to create money from nothing. That seems utterly absurd given the state of that. But then overall, money should compete, right? So what we call money and currencies, like systems of money, should compete. They should readily be able to compete so they get more efficient. We just have held this particular state artificially in place for such a long time that we sort of took it for granted. There's no reason to. Just like there's no reason for you to use a rotary phone anymore. You use a smartphone and have a fixed fee attached to that. There's no reason for you to use a bank from a technical perspective if you don't want to. There's no reason for you to use government-issued fiat currency if you don't want to, because there's a better mechanism that solves the problem of payment store of value and other functions that money might take on better, right? Because it always exists in context, which is something important to point out. It only exists from the context of utility. So it exists in space and time. If I find $100 note here in California on the street, I pick it up, put it in my pocket and use it to buy something, right? I bend down and put in that effort. If a sub-Saharan goat herder that lives on a barter system finds a $100 note on the ground, he picks it up and lights it on fire at night to kindle his fire, right? That's the utility, ultimately. Which, as a side note, the US dollar in printed form is the second most successful export product of the United States. It costs, I think...
first most successful?
The most successful export product is refined oil products. But the second one, and by margin the higher one, is obviously the printed US dollar. Like it costs like 10 or 12 cents. To print a $100 note. And even though it's technically an IOU, in practical terms, it's not being called on, it's not coming back, right? So it's just being issued and it's in circulation until it gets shredded by some central bank and replaced. But there's always going to be more of it ultimately. Another anecdote in that space, it's not paper, right? It's 75% cotton and 25% not silk. Is it silk? Maybe silk.
Okay. At its root, decentralized finance is about disintermediation. Through digital transformation, technological progress. In the digital age, we can exchange, transact, and operate directly. This model facilitates a Cambrian explosion in individual expression and ability to act. However, it also introduces various new risks without the oversight of what is supposed to be a trusted intermediary that regulates irresponsible decision-making. The decentralized financial space remains largely unregulated. what are your thoughts on the regulation of DeFi for individual users, so not for institutions?
Yeah, I mean, we touched on this earlier already a little bit. So we see a lot of propaganda in the space from regulators, government organizations, and so forth, which usually sounds something like, we will regulate cryptocurrencies, we will regulate blockchain-based solutions, we will regulate decentralized finance solutions. That is simply semantically and intellectually it's semantically wrong, intellectually dishonest, because what they're really saying, what any government agency is really saying, we're going to regulate the behavior of people within our jurisdiction to engage with certain technologies. And if they phrased it in this particular way, I would suspect that the usual response from citizens would be, well, I'm an adult. If I want to interact with certain technologies in a particular way, I should have say on that. And usually I'm not prevented from putting $100 on red at a casino here. I should be able to do that. I should be able to put $100 into a useless meme coin for all intents and purposes if I feel like it. Sure, there should be more education, but regulation doesn't address technology. Technology will just move on and will move on to where it will experience less friction. It will be used by people that want to take advantage of having less friction. But then ultimately, and we also touched on that earlier, I think, is that if you integrate the technology as intended, then you shouldn't have exposure to regulation. If you actually facilitate the peer-to-peer transaction of value in some shape or form, and as I mentioned, you do this by digital vending machines, so it's like in a narrow technical sense, it's not really peer-to-peer. There's a digital vending machine in between where you deposit and pick up an asset, all right? But if you do that, well, then there is no regulatory exposure. And usually what regulation addresses is this typical problem of having a principal-agent relationship where the agent in this case gets control over your rights or asset, and that's why you need to protect it from him or her and it. And when that's not the case, well, then there's no protection needed, i.e. There's no protection needed if I put a quarter into a bubblegum machine and pull the trigger and I can see that it works. And overall, if I can see that this particular digital vending machine fulfilled these functions 1,000,000 times in the last hour perfectly, then the likelihood that it's not going to do it 1,000,001 time is pretty low. But yet again, if I want to use an intermediary, I have to. If you want to create an intermediary, go ahead, you can do that. You just have to then deal with the consequences of being quote unquote regulated, because you're taking on this particular custody risk. But at that point in time, we're not talking about decentralized finance anymore, right? So you just left the realm of decentralized finance at this particular point in time. And you might be able to attach those two in some shape or form. You probably know this. So some centralized exchanges are passing on some of the returns that they're making from staking and so forth onto their users in form of your lower yields, i.e. you can stake a stable coin at your centralized exchange and create an 8% yield on your stable coin when the exchange itself might actually get 12, 20%, whatever it is. You can do that, right? But again, it's always at this particular point in time dependent on how risk averse or how likely you are willing to accept these particular risks. And most risks at this particular point in time are simple technology risks, and they're attached to the fact that we still need to decentralize a lot of pieces of the stack, because as you guys know, it's very unlikely that the base layer, the settlement layer, blockchain, quote unquote, gets hacked, right? It's usually that the client solution gets hacked, that someone gets phished. And there it's important to understand the difference between don't be evil, kind of Google's old battle cry where, well, we promise we don't do anything evil with your data and so forth, which they obviously do, right? They profile you every time that you open up Google, your top of funnel, but that you cannot be evil, right? So that's the paradigm. Develop a technological solution in the decentralized finance space that don't put you into a position where you actually can be evil. But as long as we have centralized systems in between that can be hijacked. At that point in time, a lot of people will still have to learn hard lessons. I assume everybody on the call at some point in time has lost access to some private key. I certainly have throughout the years, where I can see my NFT right there, but I don't have the private key anymore, so I can't actually do anything with it anymore. And the old wallet that I had has moved on, and I can't reinstantiate that even with my recovery phrase. But yeah, it's growing pains, right? We'll get there. But I think the most important takeaway here is we should simply realize that the simplest primitive is what we call currencies or money. It's solved. It's a reality that's not evenly distributed yet, that everybody simply should be aware of. Even if you don't have a digital wallet yet, and if you don't own any quote-unquote cryptocurrencies yet, that's the first thing you should do. And then the second thing you should do is request that your government subscribes to the idea of not debasing your currencies anymore, because there's no technical reason to do so, even though there might be political interest behind that in doing so. Adam, you're muted.
Thank you very much, Christian. Christian, your investment thesis is quite unique. Most firms' theses are just thematics. At Susney Capital, you use a first principles approach and the rigor of the scientific method applied to investing. I understand there's a lot behind that. Where can people learn more about your thesis?
So I actually don't know if I still share my screen. Can you tell me?
Because yes.
Oh, you
still.
I do. Okay, awesome.
Yes.
Well, then let me go back. So I regularly publish on Forbes over the past couple of years. If you want to read something more long form, Forbes limits me to 1,000 words. So what I typically do, since some of these concepts are more involved, I republish them on HackerNoon. So if you just type in my last name, which is pretty unique, plus HackerNoon, you'll find the long forms of those, which are typically at least twice as long, sometimes 7 times longer. So you'll find a lot of these concepts explained. Then we'll hopefully publish this book later on this year, and we'll do monthly webinars to explain these concepts as well. Yeah, we have very detailed thesis that we have been updating with every experiment that we are looking at. So my goal in life is just to make slightly better mistakes every morning when I wake up towards the next day. So I'll try to refine those thoughts on a daily basis. So that's what we do. And what's interesting is, this paradigm of decentralized software solutions, blockchains, is probably the largest investment opportunity we'll ever see. And ironically, as we discussed at length now, by default, it addresses all the money in the world. So from a venture capital perspective, if the lowest hanging fruit for your investments addresses all the money in the world, that's a good day. And so the way I look at this is, so money is a contract between two or more people. All other exchange mechanism, lending, stocks, and so forth, they're all contracts, right? So they're all legal technologies. They're all contracts that just have more metadata attached to that, right? So I look at this as metadata from an architectural perspective, and then understand that these are by and large sort of more like client-server solutions, so that the bytes in the middle don't matter all that much, right? So the client solution will be your robo-advisor, will be your payment function that doesn't add friction to it, doesn't delay settlement, doesn't attach fees to that, right? So by and large, people will adopt these client solutions, and chances are for most people that will take on the form of JP Morgan Chase adding a digital bearer instrument to their app that then settles instantly if enough merchants insist on them integrating it. Because it's kind of a hen and egg problem. These banks own a lot of the payment infrastructure, not only like the backbone, but they also own the companies that provide point of sale solutions. So once you see more education in that realm where merchants demand it, like the easiest one would be like the largest corporation in the world, Walmart, asking their bank is like, here, we either introduce Walmart coin, which they kind of threatened, or you can provide us with a digital bearer instrument that's being accepted by the point of sale system, which your subsidiary actually provides us with. So you can either do that, and we can finally enable our employees to be paid daily rather than bi-weekly or monthly, right? There's no reason why the reason why this happens because of the friction in the system largely. And we can also then instantly settle things, right? Because from your experience as a consumer, payments seem to happen instantly. For the merchant, before he receives his settlement with finality, it might take 90 days. Right? So in the meantime, you simply have that settlement risk. So you need to price in the settlement risk into your goods and services. So we are basically right now, I would argue, inflate every product that you're buying at a store by probably 3% because of that, right? So because of the fact that you have these intermediaries that can introduce their own fees and fines and frictions and censorship and oversight and so forth. So everything that you're buying is being affected by that in the long run, right? Because obviously the merchant will just tag on whatever it costs him to settle it to be able to make their margin, right? So in Walmart's case, if my margin is 2% and my merchant account fee is 2%, that doesn't quite work, right? So that's why Walmart, though, is in the position to negotiate 1%, whereas the local coffee shop is not in that position, right? So they're being charged 3% or 3.5%, and then they're being conned into things like branded credit cards, where the issuer will pretend they give you 2% cash back or some nonsense, right? So it's obviously nonsense. So it's not like Visa is giving it to you, right? It's coming out of the merchant's pocket, who simply already tacked it onto the price that he's charging you, so you're paying yourself with that. It's sometimes the absurdity in the space that we created here is just outrageous on a daily basis. When I hear people make these cases like cashback and so forth, it's just that we need more education to bring awareness to the fact that this simply doesn't have to exist, right? We don't need these systems. But yeah, coming back to the original question, so we have very, very, very detailed theses around all these topics, around the topics of payments, around the topics of lending, around the topics of cryptographic primitives that are more complex, that also then provide ultimately function to the decentralized finance space. Think about things that we talked about earlier, like the graph and so forth, to get data from these instruments that can be fed back to dApps. So we work on these theses on a daily basis, and unlike most venture capitalists who use that term thesis driven as a synonym to a theme, for us it's not a theme, right? For us it's an intellectual exercise, and we're using, as you mentioned, the scientific methods as much as possible. Hence kind of the closing statement here: whatever I'm telling everybody, this is mostly meant for peer review, right? It's like, if I'm wrong on something, I want to know sooner than later. If you have good data and information, please share it with me. That's why if you read my stuff on Hacker Noon, it will always say at the bottom, this is meant for peer review. I don't need you to like it. I need you to tell me where I'm wrong so I can make better mistakes tomorrow.
Well, thank you very much, Christian. It's been absolutely fantastic. When we first were planning this event, we were planning a panel, but after having a conversation with you, I knew we had to give you the full time slot. It's been wonderful.
Well, thank you. We're still only obviously scratching the surface, right? So
Yeah.
there's a lot more that's more technology nerdy that people that develop solutions would help them to understand that, like that speak to Web3 topology, right? So I do a separate talk on that, on cybersecurity. So those are primitives that if you're developing solution in the space, you need to understand, right? So you need to understand the topology that we think is emerging. And obviously we have a lot of data points that we can pull from, because we get pitched a couple of times a day. We looked at more than 1,000 of these experiments, so we can most of the time can already tell you if an experiment has already been run, which you see the same experiments that have already been run on a daily basis, right? It's unfortunate because, as you can probably tell from how I'm presenting this, for me this is not an opportunity to make money, albeit that's an externality, but for me it's an externality of doing the right thing. And the overarching goal here, and that might sound esoteric or foo-foo, but the overriding goal is to create reality consensus again. So the World Wide Web, the internet, which the World Wide Web was built on, the objective was to coordinate human behavior. But we have let it degrade into kind of this digital landfill rather than actually doing that. And so we splintered reality, right? So everybody can find their own biases confirmed. As human beings, we tend to look for confirmation for things that we already believe in. So as an externality, though, of how we let for-profit companies run on top of the internet, right? So these are all applications run atop of the internet, Google, Facebook, and so forth. They're running atop of the internet. They're platforms, right? So they are basically games that use you as a non-player character, right? And then indoctrinate you into whatever the objective of that for-profit organization is, which could be social engineering as a service to make their actual customers more money, but it's not to make you better off. And to me, ultimately, technology needs to serve human beings, right? And the overarching objective that I see as very, very important to point out is we need to create reality consensus again, because before we do, we can't really rally around the same objectives and fix the problems that all of us have. So aging, climate change, the things that all of us experience, right? That's what we should be doing.
Fundamentally, scarcity.
Scarcity, yeah. Ultimately, that's one of the points of technologies, right? Yeah. Solve for scarcity. Yep.
So I would say that overall, in order to improve the reality of the masses, it comes down to education and awareness, and we can package that together into an application that cultivates discipline through its use. And this is how we strive towards the betterment of society and civilization and humanity.
So I would like to think that decentralized financial technologies will reduce the scarcity of wealth and hopefully in part drive the development on those fronts of climate change and aging, with more people with capital to allocate. But that's hopeful thinking.
Yeah, I mean, I guess we can already observe that, right? So we can really already see that. So there are some people that already opted out of the fiat world. So I was just listening to Bill Barhydt, who's a great speaker, and his objective has been, and he claims he will make that possible, that he will entirely be able to live without a bank. I just like you are entirely able to live out without a rotary phone, right?
Yeah, I think we say that the problem of fiat's been solved. With the advent of decentralized finance, banking is obsolete. It's legacy. It's completely unnecessary. Banks used to serve a purpose, which is to safeguard assets and enable transactions with decentralized finance, with digital assets. Technology, private keys, that's been solved. It's now a legacy, entirely a legacy function, entirely extractive, doesn't add value.
Yeah.
Other than perhaps maybe loans, and they do have some of these services. But
well, to put a finer point on this, it's another metaphor, and again, some metaphors are not helpful, others are hopefully more helpful, like the digital vending machine is a helpful metaphor in my book. But the other metaphor is, the way I think about this is to transition the functions that these custodians fulfill. So think about this in terms of, if you have a safety deposit box at a bank, for example, right? So the way a safety deposit box works is you get a key, the bank has a general key. If you want to engage with the goods and valuables that you keep in the safety deposit box, you go to the bank teller goes into the vault with you, unlocks the box, leaves the room, you take out your key, you unlock the box, you do whatever you want with your valuables, lock the box again, bank teller comes back and locks the box again. So they don't have possession, they don't get to control over the things that are in the box unless they are presented with a court order, right? So point of this particular metaphor being is, that's how I like to think of the functions that banks should take on in the future. Like if you want a digital lockbox, then yeah, that's something that might be useful for me, because maybe I don't want to take possession of all my private keys and want to have a secondary option in case I do something stupid with that. And so that's a good function for a bank to do. And then other than that, go back to the original functions that the banks used to have before we let them actually create money from nothing, right? And so to actually judge what is lending for productive purposes. Right. Because we have enough, I mean, to the point of the person asking earlier in terms of money creation, we have all the digits that we need to forever facilitate commercial activity at scale at this point in time, right? And to the contrary, we probably should like reduce it to a point where things like pennies actually buy you something again, right? So there was a reason why we created these particular technologies and instruments, but what can you buy with a penny today, right? What can you buy with a nickel? What can you buy with a dime? We're basically creating them out of nostalgia, right? But like, I don't know about you guys, but in the rare occasions where I get some of those things, they end up in my glove compartment or somewhere, and I'll never look at them again. Or typically I just leave them with the cashier. But the point there being is, we created these because they served a utility. Like the New York Times was originally sold for a nickel, right? So once we can recreate this particular pricing function, there's no reason why we shouldn't be able to do that again and actually use what we call money in the way that it serves a reliable, consistent pricing function, right? And where you can just apply the same measure, which is really what it is. It should measure value, right? So 100 cents should always translate into some particular utility. There's no reason for that measure to get smaller or bigger at all. Right?
I totally agree with you. I mean, what is the function of a penny? And I mean, even 20 cents, 50 cents. Myself, almost all of my small coins have been turned into art somewhere in my home.
Right. They end up in some drawer, best case. But also, obviously, think about the externality it creates. So whenever I see one of those big, heavy, diesel-powered trucks that pick up bags of cash and coins, think about those externalities that you're creating. I haven't seen anybody doing the math yet, but my hunch is that simply the fact that we are still creating these coins probably creates more carbon emissions in terms of people shuffling these things around, creating them, than Bitcoin in any given period, right? Which is yet another red herring, right? The whole Bitcoin energy discussion is just
nonsense. It's total propaganda.
Yeah, I mean, you can simply explain this with the fact that, well, by just looking what Bitcoin miners paid for energy, right, and which was somewhere between 5 and 6 cents, I believe, last year per kilowatt hour. So point there being is if you look at your electricity bill, you will find out you paid way more than that. And the point of that exercise is, well, if the energy producer could sell it to someone that pays more, they would. They're just paying it because it's excess energy that they otherwise couldn't find demand for someone that would pay them a higher price. That's why, I don't know if you saw that, that's why Texas is actually now embracing Bitcoin mining specifically. So the state of Texas has an agreement for Bitcoin miners that contribute to the creation of energy, and then they just, in the rare occasions where the state needs more energy, they just shut it off for a short period of time. But by and large, they're producing energy for the grid and making good use of the energy, because it's a global market. It's the first global energy market, first global efficient energy market. Comes back to the earlier point. The market will do its job if you let it, if you stop interfering with it. So the whole discussion about Bitcoin contributing to energy waste is just utter nonsense on face value. You don't have to do any math. You just have to look at the numbers. They are readily available to anybody who can read. And by the way, we know who created this particular narrative, who financed the particular narrative, where it came from. I'm not going to speak to it publicly, but I can tell you.
Yeah. I do agree with Richard Hart on that, on Bitcoin mining, that it is not so much proof of work, but more proof of waste. And that with proof of stake, which is a more efficient mechanism, it's there isn't much of an excuse for any additional blockchain, especially Ethereum, to be using proof of work.
Well, we know of a project specifically that's actually starting to utilize that particular mechanism to actually do compute for AI simultaneously. So it's no longer going to be wasted.
Okay.
But then the obvious, the other part to that extent that's always been left out of the discussion, well, if you're actually using it for payments, so ignoring the settlement layer, then there's hardly any energy, right? So if you're just opening up a Lightning channel, there's basically no energy attached to that. So that speaks to the actual utility, to the actual payment function, right?
So of this AI, what is is that a central AI?
No, so the algorithm will make the computation available for other purposes, like the computation that's needed and the computation that's being done to randomly guess the result, as you guys know, right? To partake in solving this puzzle. They are working on an algorithm that works, I'm going to say alongside. I don't know if that's technically correct. You would have asked him. The engineers that are working on that are much smarter than me in that particular regards. But so it will start using that for actual use for computation, solving artificial intelligence problem. Even though I don't really like the term artificial intelligence, I think that's kind of a non sequitur. Different discussion.
All right. Well, we're reaching 1:30. It's been absolutely fantastic listening and speaking with you. Just FYI to the audience, this meeting's been recorded and I'll be publishing the video soon on YouTube and some of our other channels. And thank you for listening and staying with us for all this time. Before we end, I'd like to announce our next event. We'll be doing a panel on the mass adoption of DeFi next week at the same time. The speakers are John Patrick Newlin, founder of Mantra DAO and Soma Finance, David Sloan, Chief Investment Officer of We Are Future Tech, and Ali Jamal, founding partner of First Check Ventures. So thank you very much, everybody.
Thank you all. Thank you, Christian.
Yeah, very well.
Thank you, Christian.
Talk to you guys soon. Take care.
Speak to you soon, Christian. Bye.
Bye-bye.
Recording stopped.